Bitcoin's over here in orange. All right.
All right.
So Bitcoin, we only have data that starts in 2012. So unfortunately, we can't compare all the past data. And even more unfortunately, Bitcoin started in the middle of this big pump and dump season over here, right? So the yield curve is the interest rate stayed flat. So this was the period I said with the most money, the largest expansion ever on record for the U.S. economy. Oh, Bitcoin comes out and launches out of the gate. It goes from freaking $2 to $900. Pretty spectacular. That's when Bitcoin starts to get on people's radar. But now let's take a look at these patterns. Now, so far we haven't I haven't been showing you any type of math here, right? We're not doing any sort of calculations. We're just taking a look at the shape of these curves and how they relate to each other, right? Pretty simple, right? You don't have to be a meteorologist in order to be able to take advantage of trends in the weather. You can make decisions based on that, right? When I had to choose when I was going to get married, I chose it based on weather patterns. You can do that, and the same sort of things happen in the stock market. So sometimes people feel like, oh, the data is like so obtuse, and it's so difficult to understand, and there's so much math involved, there's so many numbers involved. You can actually spend a lot of time looking at financial information and never have to deal with specific numbers, just looking at shapes and relationships.
We haven't even really we haven't done math here today, so and I'm understanding what you're talking about.
Exactly. And you're mentally deficient, so
How dare you
we see
speak
here the
truth?
we see here, so in this period over here, this blue line here is increasing, right?
Yeah.
So we're always going to look at these three things. We're going to look at the yield curve, what direction it's going, the yellow line, quantitative easing, how much money is the Federal Reserve trying to pump into the system, and where is our interest rates set, right? Over here, we have a nice perfect storm. We have not only is the blue line going up, which means more lending is likely, um, and the quantitative easing is happening. So this yellow line is going up as well, and the teal line is flat. So perfect financial conditions for money's just sloshing around the economy, just wine glasses spilling, and people don't care. And let's order around on the house. That's what's going on over there, and it just skyrockets up. You see that Bitcoin just reaches crazy highs. Then Bitcoin falls. Then Bitcoin falls over here 85%, right? Now, it's not like it was at the beginning, right? But anyone who bought the Bitcoin around its mania over there, like I said, the buy and hold strategy works.
What price was that?
That was 900. It fell from 900 down to $220.
Woof.
Brutal, right? Oh, but let's take a look at what we're seeing here. We're seeing here that at this peak, right, or near this peak, the 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 yellow line, the amount of quantitative easing that's happening, is decelerating, right? You see, it's
Mhm.
decelerating, right? And so, if you were to hear a car go, then you know that there's less gas being given to it, and the momentum will eventually cause it to slow to a stop, which is what happened. And as that excess money started going down, we also saw that the yield curve peaked, that it wasn't going up anymore, which means that the spread between the short term and long term interest rates are not getting wider, and so that momentum of increasing lending that's happening starts to decrease. And it's no surprise then that as the gas comes out of the car, um, the wind comes out of the sales of Bitcoin and it sells off. Does that make sense?
Yep.
So the Federal Reserve doesn't. There's no interest rates being cut over here for more money to come into the system. Quantitative easing is slowing down, and the yield curve is falling or peaked. So there's not as much lending. Boom! The amount of the speculation in the Bitcoin market comes out. This is a good point to mention that in any asset, you have the people who are buying the asset for long term holding. Doesn't matter what asset it is, because owning the asset is better to them than selling it. That's true for people who buy stocks because of a dividend. That's true for people in agriculture who are buying supplies, oil and wheat and fertilizer or whatever to have for their farm. They're not looking to sell this right now for a profit. They're looking to have access to this later on. It's true for pension funds. It's true for any number of assets. There's a core of people, a percentage of people who are holding it, who have no intention of selling it short term, and then there's people who are speculating on it. Right? They are they're anyways, they're speculating. They think a change might happen. They want to bet against the market. They're using leverage in order to get a lot of money in short term moves. Any number of reasons, as speculators. So when money dries up, speculation starts to drop, and those people have to sell, 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 right? For
Mhm.
all kinds of crazy reasons, they got to sell. They're forced sellers, and they have to sell at whatever price, and boom, the price falls down. And
Hey,
so,
so doesn't it mean that when the uh, wherever it lands, once it crashes down, that floor is kind of like you've gotten rid of all the speculators?
exactly, mostly of the speculators, of all the forced sellers. So over here for Bitcoin, that was around $250 between 2014 and 2015.
So the floor of an asset, especially of a speculative asset, can let you know the strength of that asset.
Exactly. The amount of percentage fall, right? How many speculators got pulled out lets you know what are the people who actually needed this. What price are they sitting at that they're okay to hold that?
Mhm.
But this is given the idea that the asset is still the desire for the asset, the demand for the asset stays stable, right? You know, if you look at Pogs, the demand for Pogs fell off a cliff. So there was no floor in Pogs, Peter. But when it comes to when it comes
I
to
love Pogs. Oh God.
when it comes to Pokemon cards, people play Pokemon all the time, right? So there's always going to be a group of people, or there as long as that demand stays there, you can have a floor in the prices. Same thing with comic books or anything like that. All right. Now, then we had uh, after the floor in Bitcoin came in, we were still in the expansion phase, right? Now, even though the Federal Reserve started increasing interest rates over here on the purple line, and the quantitative
Wait,
easing,
what purple line?
sorry, not purple line, the teal line goes up. That means the Federal Reserve was increasing interest rates, which means they were trying to curb um, demand for lending. They wanted less lending to happen. They wanted to slow down the economy. But there was still momentum in the economy because you see here the yield curve hasn't inverted yet. It's not even close to inverting. Like around here, the yield curve is still fairly high. In fact, it's where it was before it bounced off last time. We're not even at inversion yet, right? And
Mhm.
so there's still money sloshing around in the system. There's still momentum, and so that's why we see the stock market goes up, still goes up, and the Bitcoin still goes up, right?
Why is the Fed increasing? Why is the federal rate increasing? Why are they doing that when it doesn't seem obvious that they would do that?
For a number of reasons. Here, I believe that I don't have to go into explaining what the Phillips curve is, but essentially, when we talked about the inventory cycle, right, we said that there's an ebb and flow in inventory, but that also coincides with an ebb and flow in employment, right? And so when you get to maximum employment, where there's the labor force is maximally employed. I mean, what's considered maximum employment is a whole other story. But let's say if you put up a position for a job and you're finding it difficult to hire somebody because people are already in positions, you have to offer more money in order to convince someone to leave the job that they're at in order to come to you, right?
Mhm.
Because they're like, okay, well, you have to give me more money for the opportunity. And so what happens is that when uh, the someone's salary is one of the or employment costs are one of the biggest costs for a company and the hardest number to change. And so what happens is that the company who has to pay higher salaries to the employees, well, they're not taking a smaller profit margin. We live in a capitalist society, Peter. They're not taking smaller profit margin. What they're doing is passing on the cost to the consumer, right? And so the prices for items start going up. Prices for goods and services start going up because the companies have to flow those price increases down to you. And so, and generally the population has more and more the ability to pay these prices because they're employed at higher rates, right? Their wages are going up. But what happens is that if that cycle, the idea is that if that cycle were to go unchecked by the infamous central bank, Federal Reserve, that prices would then skyrocket, like we saw, like what happened in the '70s, and inflation would get out of control. That prices with things would keep getting higher, and people would demand higher wages, and the cycle would just continue until prices got out of control, which is ridiculous, but whatever. Um, and so the Federal Reserve wants to stop that. And so what they do is they increase interest rates to increase unemployment. They increase interest rates so that lending happens less, and people who are on the margins can't get loans, and companies start having to curb their costs, and things come down, and inflation expectations lower.
Why does the interest rate going up make it so that lending happens less? I thought a higher interest rate incentivizes banks to lend.
No, the
Oh,
higher interest rate decreases
it makes it so
the
people don't want to borrow money.
no, it makes it so that lenders don't want to lend money
A higher
because
interest rates. The interest rate that's going up, is it short term or long term?
always short term,
I see. So the short this the buffer gets, the cushion gets smaller.
smaller and smaller. Exactly,
I get it. I get it. All right. All right. I almost
and it
lost it
costs
there.
more. It costs more and more for companies to the interest rates going up. So let's say as the interest rate was going down last time, they were taking out loans to run their businesses or whatever, to buy houses or whatever it is, and now the interest rates are going up. Well, they can't get and they could only keep that Ponzi scheme going by getting a new credit card with a lower interest rate, a new loan with a lower interest rate in order to pay the previous one, right?
But if it's
And
going
so
up, then they can't
if
get
it's
that
going up,
card.
they can't do that.
Gotcha.
Exactly. And so it's called a debt burden, and it crushes growth, which is what the central banks want to do. They want unemployment to go up. They want things to go bad for the good of the economy, Peter, because otherwise inflation will be out of control. Where would we be if we didn't have the central banks? The central banks have been around ever since mushrooms have been on the planet, which is fairly long time, Peter. So they're going to live into their wisdom, and they always get everything right. They never get anything wrong.
That's right.
I have to say that on YouTube, or they'll take down our channel. Um,
Not yet. Soon.
Exactly. All right, so we'll switch back to the chart over here. So you'll notice that Bitcoin is going up, and the stock market is going up. So the stock market keeps going up over here, and Bitcoin goes up. And you'll notice that right around the same time, so Bitcoin peaks and rolls over. Bitcoin peaks and rolls over, and then
What price is
shortly
that?
after, that price is uh, 19,000,
Mhm.
20,000, yeah, 19,000, rolls over, and right after the stock market does the same. So let's just zoom in here. So the orange line peaks, rolls over. Bitcoin is far more sensitive than the stock market because the amount of money in the Bitcoin space is less than the stock market, and so and people trade the stock market. Long term holders trade the stock market less than Bitcoin speculators might, and so you see things turn in the crypto market far sooner than you see it, or sooner than you see it in the stock market, which is great. Bitcoin itself is the crypto market itself is a leading indicator for financial conditions.
How much
And so
warning did we have here, though? How
over
long?
here, Bitcoin peaked at December 11th, and the stock market peaked
2017?
2017, and then it was 1 month later, January 22nd, that the stock market peaked.
Gotcha.
Now, there's still momentum, right? So even though Bitcoin fell over here and kept falling, the stock market rallied again over here, right? Uh, never, uh, never underestimate the ability for the stock market to rally on bad news. All kinds of dynamics that happen there, but suffice to say, The stock market goes through this the shock over here. Anyways, there's a number of reasons why the shock happened, but you see that it hit both the stock market and the crypto market. And at that time, right after there, the Federal Reserve, as you see on a teal line, stopped raising rates. So they announced it; they're going to stop raising rates. So everyone knows that when it peaks out, that chances are they can start cutting rates and put money back into the system. So, so as that expectation comes about, Bitcoin increases. Right, Bitcoin increases in anticipation for more money coming into the system. Right.
Got it.
Same thing here for the stock market. But it's all really choppy. As you see here, the stock market is all really choppy because the yield curve is inverted, financial conditions are tight, there's not a lot of lending happening, it's tough, so there's a lot of volatility.
So the
And
yield curve inverts, first dip, second dip, then we get a recession. The recession happens, and then the quantitative easing goes up,
exactly. So over here we notice that
and
um,
the federal rate goes down.
well, that's right. So here's the interesting part: the the rate cuts started happening before COVID hit. This whole red part over here, this is all COVID.
Hmm.
All right. So before you think that COVID caused any of this, just take a look what happens over here. The Federal Reserve starts cutting interest rates as of July 19th. So at it's summer 2019. Bitcoin is sort of like sideways here, right? Just like we saw sideways over here. And we know that Bitcoin, when it hits, it's going sideways. It hits a floor. It's preparing to launch up. The stock market, sorry, the yield curve had already inverted before. Now it went deeply negative, and so here is the peak in the stock market. COVID hits, the world shuts down. Boom, everything plummets down. Now I should have known, Peter, had I known what I know now then, that money was being flowed into the system. Right, money was being flowed in the system here and here. Right.
Mhm.
And after a yield curve inverts, the yield curve starts to go up after that. So there should have been expectation that a flood of money was coming into, was already headed into the system. Plus, we know that the last thing that the Federal Reserve wants is for the stock market to go down and stay down, right? For since
Why is
2008.
that the last thing they want?
Well, we saw that since 2008, they've been juicing the system in order to keep the longest expansion on record, right? They don't want the stock market to go down. The stock market has so much to do with our system. Our system is a house of cards built on debt, and like we said before, if that debt gets destroyed, then the money that's created from that, the loans, gets destroyed as well. Because in our system, credit is actually money. Peter, the cash in your account, the bank doesn't care about that. Bank doesn't want any cash. Nobody wants cash. And people who have money don't want cash. They want assets, baby. They want real estate that goes up in value. They want stocks that pay dividend and that go up in value. They want to make money. Your cash is sitting there, is being eaten away by inflation. Horrible, right? And so the last thing that the government wants or the Federal Reserve wants is for stocks to come down and stay down. They'll do anything to prevent that. So any time to buy here was actually a good time to buy. There's all good buying opportunities. And people like me who are calling for the stock market to come down all over here, like to come, sorry, just to keep falling, was sort of silly. Because even if it did, it was going to skyrocket back anyway, right?
Because the Federal Reserve is not going to allow it. The major player in the stock market refuses to let that stock go down. So if you are betting against that, to let the stock market go down, if you're betting against that, you're betting against gravity.
Well, the Federal Reserve wants lending to happen because lending is how money gets issued. It is not issued because the Federal Reserve prints money. If it was, they wouldn't need to manipulate the manipulate the banks. They would just issue money. Banks create money through lending. That's how money is created. And so, what was going on over here? Oh man, all kinds of things are happening here. You can have there's going to be whole classes in universities taught on what happened after the COVID response. But basically, lending just ground to a halt, just ground to a halt because who has money who's going to lend it out in that environment? And so the Federal Reserve is like, just ratchet up, guys. Open the floodgates, the floodgates. Legolas, don't let him pass. Insane, right? Money flowed in as never before, and what did we see? We saw the blue line, the yield curve, increase dramatically. We see the stock market increase dramatically, and we see Bitcoin increase dramatically. Now, it's a little misleading here. I should tell you that the Bitcoin line that I'm showing is actually the logarithmic line, right? If I were to actually show you Bitcoin, the chart regularly, it would look like this: this orange flat, and then spike, spike, and then this is what happened in 2020.
Could
You
you
see it?
just quickly explain a logarithmic? Why is that different?
Sure. So
Only because you say a logarithmic chart is the best way to look at a chart.
the normal chart that we're looking at has the y-axis goes up incrementally. It goes from 0, 1, 2, 3, 4, 5, 6, and so on. So every move is related to every other increment, to one for one.
Mhm.
But you use a logarithmic chart when you want to show exponential growth. Because if you were to show exponential growth on a regular chart, let me just pull this up real quick. Actually, I'll show it to you here. So
Whoa. Tell me you don't look at that all day, Tom.
all day a day.
We got to put an epilepsy warning on this video.
So this is Bitcoin. Let's take a look Bitcoin here. So this is the Bitcoin chart if it's just regularly, right? So Bitcoin went from whatever it is, a couple of $100 to 20,000 here in 2018. So this is the first big bubble that we all heard for oh, I can't show my, sorry, 1 second here. Actually, I'm not going to show that. So this first big hump is when we all heard about Bitcoin. Like the whole world heard about Bitcoin. You know, that's where a crap ton of Bitcoin millionaires were created over here. And then the epic crash from 20,000 down to 4,000 pretty much took the wind out of the sails for people. They're like, all right, a lot of people bought around the top over here, and they lost quite a bit of money. But then we had a run up. Then we had another run up that happened in 2019. That's anyways, that had to do with the halving. And then what happened is that what we see here, this big explosion up, that shows you how much money was sloshing around in the system. It just exploded Bitcoin from around 12,000 to 60,000.
Pretty good sign that when people
Now,
had money, they wanted to buy Bitcoin.
well, people who have money, who have excess money, you want to put that money to work, and you want to put money into work and the thing that might yield you the highest return. And so if you have an appetite for risk, you go to the riskiest asset that could give you the highest thing. So that's what we see here. But if this chart doesn't actually show the price movements are all skewed, right? So we see here the in from 2021 to 2022, the chart is huge, and then but when you look over here at from 2015 to 2017, you can't really tell anything what's going on the chart there, right? But if you
Yeah.
change the chart to logarithmic, where what you're doing is uh, it's a type of way of demonstrating the changes that are happening between the prices. Then you're seeing here more proportionally what it was like at the time, what it felt like at the time, right? The guy who's buying Bitcoin over here at 25,000 feels the same as the guy, or sorry, let's say here at 5,000, feels the same as the guy who bought Bitcoin here at 250. It's like proportional to what it was like for them to run up and to see the run up. So
All right.
logarithmic just makes it that the chart, instead of going 1, 2, 3, 4, 5, it goes up 10, 10, 100, 1,000, 10,000, and so on. It goes up by by orders of magnitude. I'm sure that
Understood.
really mean much. I wanted to stay away from the math, but
No, it means a lot because I hear Raul Powell talking about log charts. I've heard you talk about it. I did think it's an important thing to talk about, and I do understand it now better than I have before. A log chart shows exponential ranges better than a linear chart.
Exactly. So if you have an exponential asymptote on a regular chart, on a linear chart, it would look like a straight line, a linear line on a logarithmic chart. So whenever you see a straight line on a logarithmic chart, then you know you're looking at an exponential rate.
Gotcha.
So, which is why I'm showing it here, because it's easier to see what was going on at the time as opposed to the normal, just the number of what the Bitcoin was at. Look,
All
we're
right.
talking about shapes here. We're talking about relationships. That's what's important here. Don't worry so much about the number.
Looks like we're getting to the good stuff.
We're getting to the good stuff. If we take a look at previous times of drawdowns for Bitcoin, um, which is a truer indication for the amount of money flowing around in the system, you'll notice that the first time Bitcoin fell, it fell 86% over a period of 400 days.
Oh, I feel like we're getting into this. Is it? This is what we need to know. All
That's right,
right.
and bottomed. It bottomed here.
Yeah.
Then it over a period of 1,000 days, it rose 11,000%. So if you put $1 in, you would have gotten 116 times your money. Um, so it bottom so it drops 86% for over a period of about a year, and then it increases for a period of about 3 years. Then it dropped again 85% over a period of a year, and then it increased for a period of about 850 days, almost 3 years. And now we're in this cycle, this part here, where it dropped it dropped only a little bit. It only dropped about 40%, which means if it were to drop again 85%, we should get around to around 10,000 on Bitcoin. So the question is, with monetary conditions tightening so much, right? Is it likely that we've actually seen the bottom in crypto? No. Just like over here, when you see here how this huge drop off, like right at this point,
Mhm.
right here.
Yeah.
So if you thought that this was the bottom, no, there was still more bottom coming in. If you thought over here that the midpoint here was the bottom, right? You were wrong. There was still more bottom coming in, right?
Hmm.
That would suggest that there's far more bottom coming for this right now. In fact,
Oof.
that and the stock market. Now, here's the good news.
All right.
That quick bottom, the big bottom over here and over here, does not last long, right? The drop seems pretty painful, but it doesn't actually last long. Over here, it lasted for a period of a week. This bottom over here, this bottom before it came back up was it dropped December 11th. It was down, and then by April of the following year, it was back up. It was just a couple of months of 6 months, a little bit more than 6 months, and it was back up. And so the best time to ever have bought Bitcoin was all on those massive drops of 85%. Once you got to around that area, it was never a better time. And you don't have to, you're not one of those people who bought at the top and you have to wait till the next time it got to that price in order to make your money. You're making money direct là, tout de
Immediately.
suite, immediately, right? So, and all these major drops. So the only question is the demand still there for Bitcoin, right? And the demand is still there. We've seen China ban it. We're seeing issues inside of the EU where there's talks about banning it. We're seeing all kinds of problems that would make the crypto market should be lower, but it isn't. The adoption rate has been up and to the right, up and to the right this entire time, right? And so, if you're betting on that, and you're betting a reasonable amount that you're willing to lose, the what you want to be doing is looking out for a massive drop until it gets to around 20,000 to 10,000, and you want to be buying Bitcoin around that spot. In fact, any type of crypto.
So,
And
do I sell my Bitcoin now and then wait for the drop?
The only reason to sell it now is if you need it. You can't wait until the price of Bitcoin gets back up to the level. The thing
No,
is,
but if you sell it now, you'll get a
yes,
pool of money, and then you'll be able to
absolutely,
buy more Bitcoin when it gets down to 10,000.
absolutely. So that is a strategy.
That's
Totally.
trading. Mhm.
But for me, the person I would say the person who bought it lower, like if you bought it lower and you're in the profit, sure, sell all of it, sell some of it, and wait for a drop and get back in. Now it could be wrong, right? It could always explode from here. Like I'm not trying to say that that can happen, but what happens is that the you got to look at the risk reward, right? It's about money that you don't want to lose. So if you sell it now, even if you're wrong and the price goes up and it gets to new all time highs, well, the next time we see the previous high, it should be it's like when we saw it over here. So over here in 2014, we see that high again over here, right? But that wasn't a bad time to buy,
Mhm.
right? Because then you had still a huge part of the move coming up. If you bought it over here in 2018, and you have to hold all the way till it got back up to where it was in 2 years later. That's not so bad. Remember, this move over here that we're seeing that looks like such a tiny move, in tiny move. This move is bonkers, right? Let me just remove the indicators. Right, this is a pretty right? This is a pretty substantial move. So if you bought it over here in 2000, at the beginning of the chart over here in 2017, 18, and you had to wait till 2020 in order to get it, I mean, you still got a nice write up. In fact,
Mhm.
you're still in profit even after all this drop, right? And so you just have to decide what it is you need. If you need that money to live, well, then you have no choice. I would say, I would recommend that you sell it, right? If I was a
Financial advice.
financial advisor, that's what I would do. I would sell it because who wants to write that down. Um, so let me just put this back up. But if you're looking to buy, if you weren't in the crypto space, you feel you missed out. I would say now is not necessarily the best time to jump in. But the best time to jump in would be at the next fall. Any time during the next fall, any ride down from the previous low, let's say from 30,000 all the way down to 10,000, you could be buying a little bit, a little bit, a little bit, a little bit, because within fairly short period it could be. Well, here's the thing, Peter. Here's the last thing I'm going to end on. This is a 2 hour stream. I can't believe we've been going. You guys have been very patient, and I appreciate it. Um,
It's been great.
what happens is that we know that the government and the Federal Reserve doesn't want stocks to stay low, right? They're going to want it to go back up because it's going to be super painful. So they're going to jack up rates. If it's anything like it was last time, they won't be able to get up to more than half the previous height. So they'll get to 1.5. I have my numbers say something between 1.5 percent interest rate to 2.7 on the 10-year interest rate. So it'll get back up to a certain period. The yield curve will invert. We'll have a recession that happens. And when the yield curve inverts over here, sorry, no, once the yield curve inverts, we know that likely the yield curve will then bounce up again from there, and that the Federal Reserve, whatever interest rates they raised it to, they're going to lower it, right?
Mhm.
And just for good measures, they're going to kick this up a notch, right?
Quantitative easing,
Exactly. Quantitative easing.
the yellow
So
line.
then you're going to have, just like we have the perfect storm of bad stuff happening now to bring the stuff down, we're going to have the perfect storm for, my God. I mean, unless we're talking about the global financial collapse of the economic system, in which case, bullish Bitcoin, right? But chances are they're going to just dump massive amount of money, and we could see a skyrocket, uh, just to the moon price.